Next guest says stocks have moved past the sweet spot. Mike Ryan is head of wealth management research over at UBS Financial Services, which oversees $655 billion. Mike has been with UBS for over 10 years. He joins us right now from their offices in New York with the outlook for the rest of the year. And before we get to that, Mike, let me ask you, a lot of deal flow today and also talk of potential deals. Interesting. It's kind of like a typical merger Monday when things were going crazy a couple of years ago. What do you make of this significant uptick in deal flow again?
What I make of it is two things. First of all, that the investment environment and also the economic backdrop is improving enough that companies now are more comfortable deploying their cash. And the second thing I make of it is they're sitting on an awful lot of cash. Now, keep in mind that internally generated cash flow has been strong, and they're going to spend it in one of three ways. They're either going to reinvest it in the business through capital spending, they're going to go out and do share buybacks, they're going to do M&A. So I think what you're going to see is a little bit of all the three of those are going to wind up deploying that cash over the next couple of quarters.
Hey, Mike, I wonder, if that doesn't provide another sweet spot. I want to show first, though, a chart here, what you're talking about. We have a chart of what happened from the highs in October 2007 down to the lows in March. You see the drop 57%, for example, in equities, the S&P 500. We have come back more than 73% since the March lows. And you see that looks a lot more, but of course we're not yet back to the levels we were at back in October of 2007. And as Carol mentioned, so much deal flow. Why don't you see a lot more movement here to the upside?
Well, first of all, I think what we've benefited from is three sets of extraordinary circumstances. Exceptionally undervalued markets. In fact, you had markets trading at such distressed levels, we were almost discounting a replay of the Great Depression. You saw this extraordinarily supportive policy mix where policymakers had essentially pulled out all the stops. And you essentially had an economic release calendar where all the risks were weighted to the upside because the expectations were so low. So that drove this tremendous reflation rally in the financial markets and also drove the economy so that we saw a continued improvement. I don't think that the same conditions are going to be prevalent going forward. So while you'll do okay in the financial markets and equity market returns will be normalized, you're not going to get this explosive type of move that we've had over the last 12 months.
All right, so let's talk a little bit more about this chart and about the asset allocation you talk about in your most recent note, which this kind of illustrates. Take a look here. We have fixed income. And Mike, you can explain a little bit about this. We see a rise of 7% during that period from the October 2007 equity market highs until March 9th, and then a rise from March 9th until now there. But I want to really focus on the commodities. And if you take a look at commodities, you see a drop during really what was the bear market to what we're seeing here is the bull rally. 27% is the rise since the March 9th lows. Do you think commodities is a place that's different than equities because of the global nature of the consumption there?
We do. We think a couple things is driving that, Matt. First of all, as you pointed out, this continued resyncing of the global economy and the fact that it will be driven by stronger growth outside the United States in places like East Asia. But also, let's not forget that largely because of the strength of the dollar that we saw early in the year, that the commodity markets actually trailed the equity markets. While equity markets posted significant returns in the first quarter, commodities did not. So what we expect to see going forward as the dollar trades in more narrow ranges, we expect to see some catching up because this continued strong growth dynamic is going to drive demand for commodities, and that should force repricing in that side of the market as well.
All right, and then finally, as far as asset allocation, you have in your chart cash here, and you see very little movement there, up 3% during the downturn, hasn't moved since then. It's closely related, though, I got to guess, to fixed income. And you talk about fixed income as being not separated here as far as the credit markets and the treasury markets. What do you think about the fixed income segment going forward?
Well, we think in the fixed income markets, the outlook's going to be a bit mixed. We still think that interest rates are biased higher. Look, the Fed's gradually going to start unwinding this accommodative policy mix. It probably doesn't happen until the very end of the year, early next year, but the markets will start to build on that. And then when you put on context also the fact that the economic recovery process gains traction, that the worst of the disinflationary, deflationary process has passed us, those things suggest that rates will lift. So we want to be careful in terms of how long a maturity, how much rate exposure, but I still think that this catalyst that's been driving this compression in credit spreads, this powerful driving force that's led to better positioning of corporate balance sheets is going to continue through the balance of this year into next year. So the credit side will be supported.
Mike, it was interesting what you just said about rates. We talked to Martin Feldstein earlier today in terms of whether or not the recession's over. He didn't rule out completely the possibility of a double dip. I mean, have you kind of taken that off the table completely?
Well, look, I never say never, especially after what I've seen in the last 24 months. What I would say, however, is double dips don't happen by themselves. They have to have a catalyst. Something has to drive it. So you look at one of two things. Either it's an exogenous shock, it's that bolt out of the blue, and it could come from sovereign debt, or it could come from issues on the geopolitical side, or it's a policy mistake. Policy makers raise rates too quickly, or they raise taxes too much. Those are the types of things that typically drive a double dip. It doesn't just happen because we're at that point in the business cycle where we're overdue for double dip.
All right, hey Mike, thanks so much for joining us. Mike Ryan there from UBS.